Hey guys, this is Mobashir, and today we are going to analyze the Coforge Limited. Basically, we are going to analyze its fundamentals, technicals too. So let's start the video with the technicals part. Okay, and Coforge, here it is. Let's go with the yeah, okay, okay. Let's remove the indicators. Okay, move towards the 1 month chart so that we can understand where it is moving. Okay, here you can see the upward movement that is very excellent here. I mean, it is quite too much volatile, we can say that, right? It is going upward downward here, right? And it is continuously making higher highs, no, not higher high, it is equal. It is not able to break. It is resistant here. Okay, means it is now down around only 16% from its all-time high, right? And it is not that much far away. I mean, it is continuously doing very well in terms of technical part, right? And you can see that it has given very excellent returns in the past. I mean, if I talk about it from 2020, it has given around 640% returns at the current level. That's good. I mean, it is doing very well, and now it is also trading at the prox. It is all-time high, right? And the volume is quite consistent. That's good. And let's go with the fundamental part. It was like okay, okay. First, let me tell you what is this Coforge Limited, right? I mean, first of all, Coforge is not a typical IT service company like TCS or Infosys. It is a mid-cap, vertical-focused digital transformation company. You can see it in this image tag. Okay, this vertical focus IT and digital transformation. I mean, this means Coforge does not try to serve everyone. Instead, it focuses deeply on specific industries and build domain-heavy technology solution for them. Right. That's very important to understand, right? I mean, which industry does the Coforge operate in? I mean, at a brand level, Coforge operates in the IT service and digital transformation industry, as you can see. But if we go one level deeper, it is real strength lies in three core verticals. First, BFSI, that which includes banking, financial services, and insurance. Second, travel, transportation, and hospitality. And the third, insurance, platforms and core systems. This vertical's focus is what separates Coforge from many generic IT companies, right? I mean, if I talk about globally, companies are still midway in their digital transformation journey. Banks, insurer, airlines, and logistic companies are still migrating legacy systems to cloud, automating operations using AI, using data analysis for decision making, improving customer experience digital. This is not a one-time upgrade, right? This is a multi-year, multi-phase projects, which means IT spending here is structural, not cycling. Okay, so that's the part. Okay, of the okay. So it was the introduction part for the Coforge Limited, right? Now let's start with the ratios and other fundamentals of this stock. Okay. So if you look at the market cap, it is a mid cap, as I told you, and the stock P is now trading at the 43.7. And if I talk about the industry P, which is 24, right? As you can see, there is a huge difference. It is around 20. So now it is, we can say it is trading at the it is premium as per the peers. If we compare with the industry peer, right? Return on capital employed and return on equity is quite not acceptable, as it is a service based company, right? And they should it should be around 25, 20, right? 25 or 20. Promoter holding, okay, it's zero. That's quite too much concerning, and change in promoter holding is around 40%. We will look at that. I mean, what's the reason behind that? Okay, interest coverage ratio is quite low. That's not acceptable for me. I mean, I look forward to the company which have lower higher interest coverage ratio. Debt to equity ratio is quite good, but still I think they are not able to make that much money, because of which they are not able to pay their interest obligation that efficient. I know that for you people it is quite good. Interest coverage ratio of 12 is quite excellent, but for me it is not, because I look forward like 50, 15 to 17 and all. It is quite good for me. And EPS growth is for the 5 years is quite acceptable, and for the 10 years it is quite excellent. Quite quick ratio is good. Okay, I mean, and the current price to the book value is quite high, right? And sales growth is quite very excellent. I mean, for the 5 years it is very excellent here. Average dividend payout is also good. I mean, companies paying very good dividend out of their profit, because their dividend, if you look at the dividend, you come to know that they are hardly paying like 1% approx there. If we compare with it is stock price, because their stock price is already trading up to like a price to book only of around 8, quite trading very premium. Also, if you come with you, if you look at the P and compare with the industry P, we know that they are the stock price is trading at very premium, right? So let's see the trend of the P and APS growth over the years, so that accordingly we can understand what's the average of this industry P. Okay, like it is not working here. Now it is showing. Okay, so if you compare around 2015, they were having a P of around 11 only, an APS of 6, and 2021 they were having a P of 54 and EPS was around only 15. Yes, yes, and now they were having a P of around 7, no, around 48 weekends 54, and the EPS of 34. It is not justifying their average P, we can say. We can see, but they are not justifying that. It should be around here. Look at this. It should be around here. Okay. So now if we quickly compare with the peer comparison, you can see that it is around 8 level. Okay. Quarterly sales variance, it is good. If we compare with the peers, PAG ratio is not that much good. If we compare with the peers, EPS for the 12 months is quite acceptable, we can say. Sales variance is also good. Profit variance is good if you compare with the peers, and the index coverage ratio is quite low, as I told you. If you compare with the its peers, current market price to the book value is quite average. If you compare with the peers, EV to EBITDA is haven't we haven't looked at there, right? EV to EBITDA is also quite acceptable, as it is a service based company, right? Software based. Return on capital employed and return on equity, as I told you, it is low, right? And debt to equity is quite acceptable, as all the peers having the same, and P is also high here. Look at this. If you compare with the industry peer, it is too much high. Now if we look at the quarterly sales, you can see that from 2000 within 3 years they are able to convert their sales into double, right? From 2000 to 4100. That's quite good. I mean, doing 100%, they are able to increase their sales by 100% within 3 years. That's quite excellent, right? It is continuously in positive. And if I talk about the expenses, the obviously employee cost is going to be the major cost for them, right? It is quite fluctuating from 58 to like 62, then again 56. Okay, that's going to affect their operating profit margin. That's quite we can say stable, around trading around 50 to 70. Okay, so overall profit, that is sort of from 200 or 250, we can say, to 300. So they're 230 to 300. So they are able to increase their profit by around 70%, if I'm not wrong, right? So even though their sales are increasing by 100%, but their profitability is increased by around 70%. That's showing that they are having a like gap of 30%, right? So here you can see that their interest obligation has been increasing, and their depreciation is increasing very huge rate, right? Maybe they are doing very huge expenses, or like they are having like more asset now because of their depreciation expenses increasing condition. And now if I talk about the profit of P&L statement, if you look at the from 2014 to 2025, within 11 years, from 2300 to 12,000, you can see there is a huge difference. They are doing very well. I mean, they have increased by the six times within 10 years. That's very good, right? And it is their sales is going very steadily, we can see here. Okay, if I talk about the expenses or the material cost is reduced. Okay, manufacturing cost is increasing. Okay, it is let's see the for the employee cost. Recently they have increased their salary. I think that's the reason their employee cost has been increasing, right? Operating profit margin, somehow they are still able to manage to get around 14%, which is the lowest we can say, from 15 to 18, 18 to 17, and now the 14%, which is going to affect their net profitability. Even though they are able to increase their sales from 2300 to 12,000, that is around six times, they are not able to increase their profit by that margin. I mean, from we 240, they are able to convert that around 950, we can say, right? That's around gain of around 300 400%. That's not to justifying this sales growth, right? Anyways, if you look at the like balance sheet, reserves are increasing consistently. That's good. And borrowings, look at this, they are having a too much lease liability. That's not that much concerning, if I would say. And other liabilities, not okay, not controlling interest. Okay, here it is a huge one. They have a obligation to pay the the holders there in the company, right? And their trade payables are increasing. They are buying the goods at raw materials at the on credit basis, right? Because of it, their creditors are being increasing, and their non-controlling interest is also increasing. If I talk about the fixed asset, okay, as I told you, land in the they are continuously increasing their asset, because of which their depreciation increasing. As you can observe here, plant and machinery is also increasing here, especially in the 2050 25. You can see here. Okay. So overall, intangible asset. They are, I think, they are continuously buying the intangible asset for like patents and all, right? Because of which their asset has been increased exponentially. Okay. Accumulated depreciation, as I told, because of the increase in the like machinery and buildings, the depreciation has been increasing. Capital working process is very less. They are now doing some investment also. That's good part. But overall, if I talk about the balance sheet, they are continuously increasing their trade tables, which is a very negative part. They are not paying their non-controlling interest. That's also a very bad part. And they are not doing that much investment as per their overall profitability. And there is no capital working progress which is going on. And uh, this is the from 1200, it is in now 4000. Maybe they have recently acquired some uh, very important patent, because of which their intangible asset has been increased exponentially, right? Now if I talk about the cash flow, which is the real cash in and cash out in the business, within 3 years, they are able to generate around 15 or 3,000 and 5,000, around 5,000 crore, we can say, within 3 years, right? 23 to 25. And if I talk about here, profit before tax, so okay, within 3 years, they are able to generate around 2,000. If we, oh, not 2,000, 2,500 approx. But if I use the recent years, that means they have collected the previous cash also. That's good. I mean, they are efficiently able to collect their cash. That's the good thing. Their receivables have been decreasing. That's a good sign. Their inventory is zero. Papers is increasing. Okay, that's bad sign. And if I talk about okay, now let's go with the investing activity. Fixed asset purchase, as I told you, they are continuously buying the fixed asset investment. They are also doing some investment here. Now, currently, they are not doing any investment here. Okay, and investing in subsidiaries. Okay, now cash proceed. There is nothing to look at. Dividend where they are continuously paying the dividends. From dividend, you can observe that the dividend amount has been increasing over the years because they are now able to generate more profit because of which they are able to pay more dividend. Right? And debtor days is reducing. We can see here that's good sign. We can no, cannot say that it is reducing. It is quite floating around and it is quite stable. We can say, right? And working capital days has been reduced exponentially. That's a very good sign for the and soil holding patterns. That's the major thing here. We can see that HULSTB were having the major stake in the company. Now they have sold off, and now we can see that FIs are holding very major portion. That's a good sign. I mean, FIs are holding that means they have a trust in the company. They have analyzed in depth about these new companies, and there are multiple. You can see that the DIs are also holding very major stake here. Right? They are having 53.67%, which is very good. That's a very good sign. I mean, you know that DIs are very important players in the market. Also, FIs. If FIs and DIs are having stake in this company, there is something which we need to look at this. I mean, there must be some reason, right? I mean, if I look at the regeneration, there is Gotham seems to have resigned, so he's no longer on the board. Okay, okay. In recent time, resignation of director. Okay, recently the director has been resigned. Resignation. Okay. Our official of commercial relations. Okay. Look like there are multiple resignations happened in the recent times within 2024 to 2025, which is a concerning point. But if I overall talk about this company, it is quite first of all it is trading at the premium, so you need to wait for the like right levels. I mean, it goes down below that. I mean around. Let me show you. Okay, like below this 12 or 1263, right? Like within you can buy at the like 1200 around. Actually, I'm not a research analyst, as you can see that as per my analysis. Right? I mean, I'm just trying to analyze it and trying to learn by my own self. Okay, so if you think first of all, it is a good stock, right? But it is not trading at the high, we can say premium. So for now, you have to avoid. You need to wait for the correction, right? And now and the second thing, it is quite this business have quite good future, right? You know that the IT sector is booming too much, and the main issue with this stock is that they have quite concentrated uh, business, right? They are not quite diversified there, right? So accordingly you need to invest. I mean, you know that if there is a concentration risk, if the one player if there one major we can say customer uh, is going to change they are going to not going to give the orders to this company, which is going to impact their overall company, right? Their overall profitability. So yeah, accordingly, if I have if you want my suggestion, it is a quite good stock, but wait for the correction, and it is fundamentals and technicals are quite good, right? So thanks for the watching. Have a nice day.